All right, everyone. Today, we're going to move on from money specifically and kind of start going into the idea of banks and banking and those types of things. Now, when it comes to banking and the banks and what they do, um, a lot of people they think of it as a place to put your money. You take your money, you put it into a savings account, you save it for when you want to buy something later, either because of a rainy day or you're saving up to buy a house or a car or whatever, saving up for Christmas gifts. Um, that's usually what a lot of people think about it. That is only the surface level. Banks do a lot of things that we don't necessarily see in our day-to-day lives unless you know what to look for. Um, and they have a huge influence on kind of what happens. Like, for example, one thing that everybody's kind of talking about from time to time is the Trump bucks, the economic stimulus money that the government's going to be giving out because of the coronavirus. Yeah, banks are the things that are making that happen, specifically our central bank of the United States. But we'll kind of get into that stuff a little bit later. But these are things that, again, the policies that some of these banks can do, these big banks, they can do a lot. And at a snap of their fingers, they could literally destroy this country. And that's a lot of power. So that's why some people do have concerns about these Trump dollars that is going out. But that's stuff for another day. Today is just the most basic. Sorry, went a little dark for a second. So the most basic functions of banks is this: banks serve as a middleman between savers and borrowers. So when you take your money, your paycheck, you put it in your bank account, you're saving it. But your money just doesn't sit there in your savings account. What happens is there's two lines. Imagine two lines. One line are people who are depositing money into the bank. The other line are people who are taking that money and using it for stuff. So you take your money, you put it in the bank account, your savings account, your checking account, doesn't really matter. But what's going to happen is your bank is going to take that money, turn it around, and loan it. And so, for example, um, say you have a checking account or a savings account at a bank. You put your money in there to keep it safe. You're in that. I'm putting money in the bank line. I'm in the other line. The other line that says I'm going to take that money. So what happens is the bank just takes your money, gives it to me, and then I go off and I buy a house or a car or scuba lessons or whatever. So that's what's going on. So the money goes in, the money goes out. Money goes in, money goes out. And this is kind of how the system works. First, we have what are called fractional reserves. And we'll talk about this a little bit more when we do talk about the Fed. But the idea is this. Pretty much a percentage, because even though you put your money in the bank can't loan everything out. Um, sorry, unless the is decided that the reserve rate can be taken down to zero. That's something for another day. But but again, this is the percentage that a bank is required to keep on hand. So here's a little example. So say that the bank is required to keep 10% in. You go up, you deposit $100. What happens is $10 of your 100 goes into the vault. The other $90 goes out to someone else who's taking out a loan for something. And then what happens is this happens, but this is something we'll get to a little bit later. But just know this, and this is kind of a little trivia thing. Banks also loan each other money. So, for example, like Bank of America can loan Chase money, and Chase can loan Bank of America money. But that's something we'll get to a little bit later. But yeah, that's something for another day. But it's good to be aware that banks do that as well. So then the idea of this is really what we call capital formation. And the textbook definition is expansion of capital or capital goods through savings and investment. So this is the idea. Wealth is not your money. Wealth is not your checking account. Wealth is not your savings account. Wealth is not the $100 in your wallet. Wealth are the things that you own. Your house, your car, your pencil, your books. Those things that are created because of investment. So this is really what the idea is. You put your money in the bank. The bank takes that money, loans it out to somebody who wants to buy a house. Boom, that house can now exist. You put your money in the bank. Someone wants to start a business, so they need to take out a small business loan. They get the money from the bank as a loan, and then they're able to create a business and put people to work, provide a product, provide a service, whatever it may be. And that is the idea of capital formation. So all the savings in the bank takes that money, invests it, and creates things. And in essence, create wealth. Now, here's kind of when it comes to interest, though, because you probably thought to yourself, well, what about, the interest payments I get on my savings account? Well, that's really kind of where your interest payment comes from. Because what happens is you put your money in an account with the promise of getting some interest. Then the bank takes that money, loans it out. People have to pay back that money with interest. And some of that interest goes to you. That's really how it works. So the role of interest is kind of this. Higher the interest rate, the more money available. That's really kind of the idea. Because again, you borrow $100 from the bank. Keep the numbers a little small. You borrow $100 from the bank. 10% interest, which means you have to pay back $110. Keep it simple. And so that in essence, what happened was you created 10 extra dollars on top of all of the other wealth, the stuff that was created as well. So that's the role of interest. The role of the risk involved, because risk is part of it. The higher the risk, the higher the interest. So, and this is kind of the idea of, yeah, you may borrow $100, but you don't pay it all back. Like maybe you pay back $85. Well, assuming, about $7 of that is already interest, they made up some of their money already. Again, we'll get to that a little bit more detail later too, but this is kind of where things with banking can get a little confusing. Then on top of that, we have the FDIC, the Federal Deposit Insurance Corporation. This is the amounts that are insured by the government. So pretty much if you put your money in the bank and your bank blows up one day and they have no records or anything and all your money's gone, well, these are the people that you would contact in order to get your money back. This is pretty much like government insurance. And pretty much your money is safe up to $250,000 or $250,000. So if you have a bank account with, $1 million in there, your bank goes under, you are covered for $250,000. So you lost $750,000. Now, you can buy more insurance to cover the money, or you can split it up into different accounts or that kind of stuff. But that's there. And you will see this symbol on almost every single bank that exists, like 99.99999% of them. And yeah, that's pretty much it for what I need to cover for this. But remember, this is just scratching the surface. And we will go into more details and more nuances in the days to come. But really just be aware, because banking is a big thing. It is a very big thing. And that's pretty much it. I'll see you next time. Peace out.